Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Brian Stutland, Managing Partner at Equity Armor Investments, and Greg Lai, founder of Affinity Investments. They join me to discuss the return to volatility normalization and how the market was driven by earnings, not simply just the Fed. It is great to have you with us, both Greg and Brian. And it's interesting, Brian, we'll kick this off with you. We've been discussing this where it was good news is bad news and vice versa, but it seems as if the market, especially with earnings at the forefront now, good news is being interpreted as good news.
Yeah, it really is. And companies are being rewarded when they come out and beat their earnings expectations. We saw last week, obviously, the Federal Reserve spoke, but a lot was driven by those top names in the Nasdaq 100. And a lot of those companies, if they came in a little bit shy, it sold off, but we've seen them bounce back. And other companies that have beaten expectations have really risen to the upside. One that comes to mind, Disney just the other day, beat expectations, stock up over 10%. We see other names like such that Amazon beating expectations, stock up significantly after earnings. So it really seems like earnings matter, whereas the last couple of years it didn't. Everything was driven by inflation, interest rates, everything was trading together. Things were highly correlated. Now we're actually getting stock picking is back in vogue, and certainly earnings being a big picture of that.
Yeah, and Greg, now that we're kind of over the hump of the really thick part of earnings season, give us some stats and analysis around how performance and how earnings played out overall.
Yeah, Jill, thanks. Absolutely. The surprise here was that over a year ago, in this quarter, earnings were forecasted to be negative. And in fact, to date, 72% have had upside earnings surprise. And I think more importantly is the revenue backing those earnings. And so 65% of the names reporting in the S&P have had positive revenue surprises. When we dig a little deeper, I think we get some interesting information. The bifurcation has been the negative earnings growth has really come from the banking sector. And I know we might touch on that later in this segment. But the market is broadening, and there are more sectors, as Brian mentioned, that are starting to participate. Names like Pfizer, the energy sectors, and as you see, the growth rate is actually turning up. So the recent rally is underpinned by a surprise in earnings, and a lot of it in the consumer sector, and that's good for GDP, since about 2/3 of the GDP is consumer related.
Right. And Brian, let's talk some technicals here. We'll start with the Nasdaq 100. Of course, part of the concern was concentration that we're seeing within the Mag 7 and other related stocks. And if you take a look at some of the technicals in the Nasdaq 100, I mean, it certainly supports the move that we've seen.
Yeah, we've had a really nice trend channel moving higher here in the Nasdaq 100. And it seems like every time there's a sell-off, people come in, buyers come in, they take it higher towards that upper end of the channel. But, I'd caution a little bit here. Obviously, valuations are getting a little lofty. They're nothing like they were a couple of years ago, call it end of 2021. But we are seeing forward Ps in the Nasdaq above 20 here. And so, the stock market with the Nasdaq sort of touching the upper end of that channel, I kind of expect a little bit of a sell-off. We're getting in this seasonality where the end of February hasn't been great for stocks historically. Maybe we get a little pullback. There is some risk there. The last pullback basically last summer saw about a 2,000 point correction in the Nasdaq. I'd be aware of that. I'm looking to put on some hedges right now to sort of mitigate maybe some of that downside risk in a pullback. But I'd be quickly looking to buy into the market at that point. We've seen interest rates get to levels here where it's supportive of the Nasdaq. Greg talked a lot about earnings growth that we're seeing being a huge driver. So the fundamentals shape up for a late end of the year, nice continued rally in the market, and any sort of pullback, I'd look to be a buyer. It's just we're trading up on these technical levels near the high end. And so I'd be looking for a little correction, about 1,000 point correction, then I'd be looking to buy this market.
Mm-hmm. And anything that you're seeing from the VIX, because you had mentioned in your notes that we're starting to see normalization within the volatility complex.
Yeah, I mean, when you look at things here in volatility, this is the one concerning why I feel like maybe a pullback is coming. Because when we look at the VIX, we're starting to now see higher lows being made. And historically, when we see that, that means institutional traders are going out, they're buying puts, they're trying to add protection, drive up implied volatilities, drive up premium of options, expecting some sort of insurance, some sort of pullback in the market. So that concerns me because we've had a nice channel where volatility in the VIX is making lower lows, but now we're sort of in this pause rate. People are looking at options, seeing them fairly cheap. maybe looking to hedge at this point. So maybe we get a little bit of a correction, of 3 to 5% correction in the markets here. And so that's one thing that's maybe a concerning side of what's going in the volatility space.
Right. And Greg, from a fundamental perspective, what other sectors, we're going to talk about banking separately, but what other sectors look attractive or have value here?
Well, it's an interesting time, as Brian noted. We are at a point where the uncertainty in Fed action really creates some volatility. Typically, the long duration stocks do well in an environment where interest rates decline. Again, our takeaway is that the consumer is still strong. So sectors that are exposed to good earnings growth, whether it's leisure, hospitality, I find real estate still a little bit interesting, even though it's had a nice run. But as interest rates, or we get more firm on what the Fed's going to do, if we go into recession, then I expect traditional growth stocks to rally and do well. Or if the economy really does rebound and we see more earnings growth from here, you might see the cyclicals, capital good companies and things like that continue to rally.
Yeah, well, it's interesting. We saw small cap and large cap divergence. I mean, they were kind of small caps were the darling to kick off the year, but now that there's higher interest rates for longer, of course, they're concerned about cost of capital, the health of their balance sheets. But I think when you look at that divergence, even longer term, fine, we get an interest rate cut, whether it's 25, 50, 100 bips this year, but earnings, to your point earlier, quality earnings matter as well. And I feel like the small caps continue to struggle with that. It's almost like ready, set, go. They have, a month or two decent performance, but outside of interest rates, you still have the fundamentals you need to focus on as well.
Yeah, and then from a macro view, typically we do not see market tops without a broadening in the market. And so a certain part of this narrowness supports a longer run. And as Brian said, maybe even a rally near the end of the year, and hopefully it's broader than what we've seen. Though it is starting to broaden in some other sectors.
Mm-hmm. Well, let's switch gears, talk about commercial real estate and banking, of course, taking a little bit more of a deep dive in what we've seen with NYCB. Brian, I guess there's a couple questions here. You have mortgage risk, you have commercial real estate, there's those parallels to China's mortgage crisis. Is this idiosyncratic to NYCB, or is this something that could potentially have contagion within the regional bank space?
Well, unfortunately, it does look like it's spreading a little bit. I mean, maybe going back to what the VIX making higher lows is, maybe there is something under the pending surface of the systemic risk in the marketplace that people are considering right now. Because when you look at it, obviously China has huge problems with their real estate market in general, but we're starting to see that spread to NYBC, KKR's real estate fund, ETF, struggling as well. As you recall, almost a year ago now, we saw SVB basically have their issues, and the Fed really put a QE into the market to backstop that and prevent that from falling apart and spreading to other places. It'll be interesting to see if the Fed needs to start looking at some of these issues that are going on, because it's not just the US market and a couple of these names we just mentioned, but there's a banks in Germany right now struggling, Japan seeing some issues here in their commercial real estate. So there's a real factor in here with a higher interest rate environment, banks being susceptible to some downturns and some problems of owning debt that isn't going so well. And to me, commercial real estate is one of those. Obviously, we see more and more people, work from home or split between work from home and being in the office. And that's really had an impact on the amount of availability that's out there and affecting some of these banks. So I'm a little concerned about that in terms of a general view of that spreading and whether the Fed will start to look at that. And maybe that's a cause for the Federal Reserve to start to cut interest rates. Everybody is trying to find a reason to do it. The market's expecting a lot more than what the Fed has really indicated they would do this year. And maybe this spread from the commercial real estate industry is what actually triggers the Fed to get going.
Well, I mean, that's a good point, right? They still have to service all this debt, not just from a corporate perspective, but from a fiscal perspective as well. We have a big balance sheet we're managing there, and all of this debt has to be serviced, has to be paid. To your point earlier, KREF cutting the dividend recently, that could potentially be a sign of trouble where, they're concerned about servicing the debt. So they have to, move around capital somewhere.
Yeah. I mean, now NYBC now trading below its lows based on the SVB crisis that we had. KKRF also looking like it could trade lower than that levels here. So it seems like the risk is spreading a little bit. And that concerns me that we would lose some liquidity in the market, get a rise in volatility, And that would then bleed into other asset classes. I mean, you don't drop a bowling ball on one end of the pool, get ripples, and not have it affected all the way on the other end of the pool. Something is affected by it. The rest of the market might feel that, and that could, shake things up and cause the Fed to need to do something to provide liquidity.
And Greg, any thoughts around here as it relates to interest rates and commercial real estate contagion bleeding into the banks?
Well, I think that is rippling through to the fundamentals and the earnings forecast. On our models, we don't see the regionals as attractive. They're not floating to the top. So I think that all lines up well. And I think long term, as you duly noted, the debt issue, whether it's the national debt, creeping up consumer debt, and then sort of the issues with banking can really lock up the economy. And that's a concern, obviously, for the Fed.
Right. Let's switch gears and talk. I'm sorry, go ahead.
Just to jump in, I do think it's interesting that Greg mentions the regionals not really looking that well valued. And what happens in situations when we get some of these banking contagions? Who rises to the top? It's the JP Morgans of the world. We actually like that stock. I think it's something where they'll suck up some of the debt and provide some of that liquidity that's necessary. So moving, up the chain is probably where you want to be in the banking sector.
Yeah, well, we know the role JP Morgan played the last major banking crisis that we had. Let's switch gears a moment here, Brian. Greg, I want to go back to you for a moment. Let's talk about options here, get a little bit of education into it. Learning about an earnings play with Cisco. Greg, if you could give us the fundamentals, including the company's performance and a high-level outlook.
Yeah, good. Cisco, I mean, it's always a sentimental favorite, but recently it hasn't had good fundamentals. It's had a series of earnings disappointments. It trades like a value stock, and over the number of years it has. It's in the value index, and so it's not really part of the growth names. In fact, we see it to be more of what we call sort of growth in name only. But I think recently their announcement with NVIDIA, they're trying to get into that AI club, but for now, pays a great dividend, but its growth prospects are still yet to be affirmed in its business model.
Yeah, well, to your point, there was a lot of sentimentality within that stock. Brian, let's take a look at options activity ahead of Cisco's earnings report. Explain to the audience why you look at options activity and what you're seeing specifically now for Cisco.
Yeah, I think it is interesting. I mean, option traders, obviously, there's a lot more and more retail trading it, but there's also some big institutional players that go into option trading, and you can get some technical insight as to what's happening in the earnings. Cisco reports February 14th next week. So happens to be Valentine's Day and my son's birthday. So it should be a fun, interesting day after the close. I think it's kind of interesting what the options activity is telling us here. Actually, today, calls are outpacing puts 3.5 to 1. That means people are more trading the call side of things rather than a put hedge. Normally, that's closer to 1-to-1 for this stock. So it's rather interesting that we're seeing a divergence in that, people being call buyers rather than trading back and forth between calls and puts. And then the next thing I like to look at is open interest on strikes and where that might indicate the stock might go after earnings. And we have massive option open interest on the $50 strike in Cisco. So that's really interesting. When a stock sees lots of call activity, big open interest on a strike, that strike becomes a repellent typically after earnings. And option traders are expecting a 5% move for earnings afterwards for Cisco. So that $50 strike acting potentially as a repellent. You could see Cisco 52.5 to 55, or you can see it sell down to 45. So I think there's going to be some volatility and some movement coming out next week. And that's what makes it especially interesting to be watching here on Valentine's Day.
Yeah, well, and happy birthday to your son, of course. And Brian, in the last few minutes here, and Greg, if you could follow up after Brian, as we get past this earnings hump and we go into that earnings vacuum again, where we're hyper-focused on what the Fed is doing macro, of course, we have geopolitics that are, of course, in a heightened situation. Brian, what are you going to be looking at going forward outside of earnings?
Yeah, I think as we move forward here, the one thing we're going to be turning to our, next week we have the CPI number. We still have some inflationary plays in the market. It seems like anytime the inflation numbers come down lower than expected, we get a nice rally in the market. I think the technicals still line up for, like I mentioned earlier in the show, a longer run bull market in the back half of this year. We get into the election year. We obviously know in sort of midterm elections or an incumbent trying to run again, the market has done pretty well in the back half of the year. So I do expect the rally to continue. But again, we have all these systemic issues underpinning commercial real estate, Volatility is relatively cheap. It's easy to own some insurance right now. And it seems like a little bit of an overbought market after earnings. And so look out for a little bit of a pullback or sell off in the back half of February.
All right. And Greg.
Oh, for us, the market is rewarding earnings momentum. So for us, we'll take all this new information, refresh the portfolios, and sort of take advantage of ongoing price momentum behind companies that have reported good earnings. So that's what we'll be doing.
All right, Greg, Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.